To an outside observer, the stock market looks like unadulterated noise, a wall of flashing numbers and charts that seem to move without rhyme or reason. Look closer, and the noise resolves into a visible architecture. This is a real-time map of human emotion, documenting the decisions of thousands of traders simultaneously. Every movement on this map represents a brutal, ongoing tug-of-war between two opposing factions, the buyers and the sellers. Technical trading involves reading this battlefield to identify exactly which side is gaining the upper hand. The challenge is identifying the precise moment a trend loses its momentum and begins to reverse. One of the most reliable signals for this transition is the engulfing candle swallowed whole by the next, much like a large predator fish consuming its prey. When this swallowing shape appears on a price chart, it signals a transition in market power that traders look for to anticipate the next move. A downtrend ends with a small red candlestick, signaling depleted selling pressure. Suddenly, a massive green candle surges upward. For a bullish engulfing pattern, the green body must completely swallow the previous red one. A corresponding volume spike confirms buyers have taken control. This combination of candle size and high volume provides visual evidence that the buyers have successfully hijacked the market momentum. We see the opposite at the peak of an uptrend. Buyers push prices higher until a small green candle forms at the very top, indicating lost momentum. Suddenly, a large red candle drops, its body completely consuming the previous green one. This bearish engulfing pattern warns that the upward trend has likely ended, as sellers have now taken a dominant position. Misinterpreting the order of these candles is a common error that leads to false signals and lost capital. Consider this setup: a large green candle followed by a much smaller red candle. While the size difference is there, this is not an engulfing pattern. The larger, aggressive candle must always appear second to prove that a shift in power has actually occurred. The pattern relies on the second candle's ability to move the price far enough to erase the progress of the first. Even a perfectly formed engulfing pattern is ineffective if it appears in the wrong area of the chart. Zooming out to a macro view, we see a market moving sideways with no clear direction. An engulfing pattern appearing in the middle of this sideways range typically results in more flat price action rather than a strong reversal. These signals carry weight only when they appear at extreme points, the absolute top of an uptrend or the absolute bottom of a downtrend. The extreme placement determines the pattern's validity. Without that specific top or bottom location, these shapes lose their predictive power and become simple background noise. This technique has been used for generations because it translates the complex psychology of a crowded trading floor into a readable visual signal. Before entering a trade, check for a full overlap of the candle bodies, a spike in trading volume, and the pattern's location on the overall chart. Candlestick patterns document the visible residue of human emotion. They mark the specific points where the market's collective psychology shifts, signaling the direction of the next move.